All right, let's take a look at a little exercise dealing with adjusting entries. And in a previous video, we looked at the financial statement effects template. And now we're actually going to be making some journal entries. Okay, so this is kind of one of those things online where you have to toggle back and forth between a couple of tabs. So let's look at these entries. It says we've got selected accounts for a company called Ideal Properties as of January the 31st, 2019. And these figures here are before any adjusting entries have been made. What we're going to be doing is making the adjusting entries. So we have unadjusted account balances here. So, we have an unadjusted trial balance. We're going to have an adjusted trial balance. And then, we could do a few others if we wanted to. So here we have all of these balances. And I will tell you that, all of these items here, I don't think we're actually going to need one of these, but these all have normal balances. So we've got some asset accounts here which have debit balances. We have a liability account which has a credit balance. An expense account, we won't actually need to use that this figure here necessarily, but we're just going to add to it, I think. But that expenses have a normal debit balance, and then rent revenue, again, we're just going to add to this, I think. So that does have a normal credit balance. So do pay attention to the left and the right of all this. It might help you. All right, so monthly financial statements are prepared. This is important because if we're not doing it monthly, we don't have to make adjusting entries monthly. And as we go through these, I want to just tell you a couple things. Some of these entries we could actually make automatically in our software, and then others we couldn't. Okay, and so there's, as I look through here, we're going to do about 5 things. I would say 2 of them could be done automatically through the software if we set it up. 2 of them probably not, or definitely not. And then 1 of them could be, but might not do that. So, all right, let's look at the items here, 1 through 5. Number 1 says prepaid insurance represents a 3-year premium paid on January the 1st, 2019. So we just bought this premium, and this amount, we will need to use it. So what we're saying here is that on January the 1st, we spent $6,660 in cash. That was on January the 1st. This entry has already been made. And I know that because otherwise we wouldn't have prepaid insurance with a debit balance, right? So that is an absolute fact. Now 1 month has passed and we have used up 1 month of this deferred asset. So, but we haven't used up all of it. In fact, we have almost all of it left, all but 1 month. So what we have to do is bring our calculator over and figure out what is the monthly amount of insurance expense. This $6,660 is for 36 months, or 3 years as it says. Divide by 36, we get $185. That's our premium per month, our monthly premium. And so this is the amount that our asset has gone down and how much we need to expense this. Okay, so this is an example, especially because this is a 3-year insurance policy and it's going to be the same $185 every single month. We would actually probably use our accounting software. We would set this up in our accounting software to do this for us. We do it one time and we don't have to do it again for 3 years unless something changes. Not sure how realistic it is for an insurance company to sell us a 3-year premium. Usually they don't like to do that kind of thing. However, this is the information that we have. Okay, so we're going to make this journal entry ourselves manually, but this is normally something to be set up through the accounting software. All right. So on January the 31st, and notice as we go through this, all of these dates will be January 31st. We're going to recognize an expense, and we're just going to call this insurance expense, and that's going to be our debit amount for $185. And our prepaid insurance, which is an asset, has actually gone down by that same $185. Okay? So once we post this, once we post this journal entry, we would have a $185 expense over on the income statement, and then on the balance sheet, this $66.60, this is again after we post this entry, would then be $6,475. Okay, we don't get to see that. I just want you to kind of visualize what's going on. Okay. Second item, supplies of $850 were still available on January the 31st. So this is an example of an entry that would have to be done manually, right? So we had supplies inventory at the first of the month of $1,930, and now we have $850 left. So if we subtract $850, that will actually tell us what we used during the month, because we don't have any other purchases that they've told us about. So it's $1,080. So this is also an expense of a deferred asset. It's just that we can't predict, right? We can't predict exactly how much we're going to use in supplies. So this is an entry that would have to be made manually. All right. So supplies expense is $1,080. And then we would credit our asset account, because it's gone down, supplies, for the same $1,080. All right, office equipment purchased on January the 1st, so we also just bought this, is expected to last 8 years. So here is our balance, and we are going to need this, $59.52. And then, let me clear that out. 8 years, that's a long time. 8 years times 12 months is 96. Now I want to tell you, this is not exactly the right way to do this, but we can only deal with the information they provide us, and we're trying to make this a little bit easy right now. So office equipment, $59.52 is our cost. And we're going to divide that by the number of months, and that's what that 96 was. So that's $62. Okay, now we cannot make an entry directly to office equipment. This must stay on the balance sheet at $59.52 under what we call the historical cost principle. So we will have a non-cash expense here called depreciation. Which, depreciation, just so you know, is a method of cost allocation, and it's an expense, just like these other expenses. So we came up with a rate of $62 a month, and we're going to do that for 96 months. So depreciation expense for $62. And then what we're going to do here is we're going to use what we call a contra account called accumulated. I'm probably going to have to abbreviate a little bit here. Accumulated depreciation, and then I'm going to put office equipment. I'm running out of room here a little bit. So again, accumulated depreciation is a contra account, so it's actually located in the assets. So if you want to visualize this, we would still have after 1 month, we would still have office equipment of $5,952. Then we would have a balance of negative $62 in this contra account called accumulated depreciation. At the end of 2 months, we would still have office equipment of $59.52, and then this 62 would it'd be 124, but it would be a negative. And what that does is it allows us to adhere to the historical cost principle while also effectively reducing the assets value on the balance sheet. That's not worded exactly the right way, but it will serve our purposes. So that if an investor is looking at that balance sheet, and think about it, if we were 94 months into this office equipment's kind of old, we wouldn't want to just say, oh yeah, 59.52. We would want to say, okay, it's 59.52, but we're going to reduce that by all but a few months, right? Okay, so this is all we have to do for the journal entry. I'd just like to give you guys a little bit more than just the answer. And again, it was 62, not 124. I was just doing something extra there. Number 4 says, on January the 1st, 2019, Ideal Properties collected 6 months rent in advance from a tenant renting space for $875 per month. Okay, so we've got this unearned rent liability, and unearned rent, unearned revenue. This happens when someone gives us money in advance, but we have not been. That's actually a liability. So when we got this cash, we actually did debit cash for $5,250, and then we set up this liability account as well. Well, now $5,250. Now they've given us the amount, but I just want to show you this. Divided by 6 does in fact equal $875, right? So what we're going to do here is kind of interesting. We're going to reduce the liability with a debit. Unearned, what they call it? They called it unearned rent liability. Unearned rent would suffice. So that liability has gone down, and then this rent revenue has gone up by the same $875. That's all we have to do. And then finally it says accrued employee salaries of $490 have not been recorded as of January the 1st. Okay, so I think what we need to do is actually accrue those salaries. So we don't really need this $3,100 here. It's just going to go up by $490 when we make this entry. So again, we have some salaries here. So we haven't paid it, but we can still recognize this expense. So we would have something like salaries expense for $490. Again, I say something like because I don't know exactly what's on this drop box here. It might say salaries, it might say wage expense, something like that. But it's going to be something very, very similar. And that's going to be our debit because expenses always go up with a debit. And then what we'll need to do is we'll need to actually set up a payable or a liability for that same $490. Okay, and that's all there is to adjusting entries. I do want to kind of run through here real quick, and say again, the prepaid insurance here, this would be a good candidate for to just do this automatically on our software. The supplies expense we said would not because it always changes. This depreciation expense on the equipment, we could actually set this up in our software for that piece of equipment to be depreciated by $62 every month. We could set this item here up, this unearned rent liability. We could set this up for a recurring entry of $875 per month, but the problem with that is twofold. Number one, the biggest problem with this, quite honestly, and the only thing we would really need to focus on is the fact that it's only for 6 months. And so we might get out of doing it for a short period of time, but that's about it. And then finally, this January the 31st one here, this would have to be a manual entry that we would set up because it's not always going to be $490, right? Okay, so just food for thought. I'll close this video out now.